Hello，我係 Simon，歡迎嚟到 Old Simon's Workshop。近呢幾個月，好多人都有講巴菲特嘅組合咧，其實就跑贏翻呢個 Cathie Wood 嘅組合，就成功攞到呢個鯊魚戰衣啦，即係潮退之後邊個有着泳褲啊？如果睇翻巴菲特今年係跑贏嘅，但係喺近呢10年咧，其實巴菲特咧又跑輸呢一個 S&P 500嘅大市嘅。我而家 show 緊呢一個影片咧，就係基於我之前讀緊書嗰陣時一個研究，咁就係用英文嘅，係大概探討翻其實如果投資喺譬如一個類似巴菲特嘅 portfolio 啦 versus 一個類似 Cathie Wood 嘅 portfolio 啊，咁其實係咪真係純粹嘅二分法，只可以買入去巴菲特嗰邊咧，又或者係買入去Cathie Wood 嗰邊咧？呢一方面咧就牽涉到呢一個組合管理嘅學問嘅。咁入邊嘅內容咧就係牽涉到呢一個return 嘅計算啦，即係回報嘅計算啦，同埋有一個 concept 我之前嘅影片冇講過嘅，就係呢一個 volatility 股價 return 嘅波幅啊，其實就牽涉呢個統計上嘅標準差。呢個回報除以呢個波幅咧，佢有一個學名嘅，就係叫做Sharpe ratio。如果中文嚟講，就叫做夏普率啦，或者係回報風險比率。咁其實咧，我哋如果喺組合管理上咧，個 objective 即係嗰個宗旨，其實就係要 maximize 嗰個 return to risk 個 ratio， 即係去最大化嗰個回報風險比率。我呢段影片就係想講，如果我哋面對有兩隻 portfolio 啦，一隻就係傳統啲嘅類似巴菲特嘅 portfolio， 而另一隻係比較新進啲嘅科技股啊，類似呢個 Cathie Wood 嘅 portfolio。其實我哋可以將啲資金咧兩邊都壓住，咁樣做到嗰個回報風險比率其實係會更高嘅。
My portfolio is split based on traditional versus tech companies. Before the analysis, I would like to share my observation of generation gap in investment community. So old people are usually conservative, focusing on stability. They prefer investing traditional or mature companies, just like those Warren Buffett's portfolio. On the other hand, young people are usually aggressive. They prefer investing tech or innovation companies, just like those in Cathie Wood's portfolio. So are these gaps reasonable to exist? I would like to provide some insight through my analysis. For my 10 stocks, 5 are traditional or mature companies. Coca-Cola, Johnson & Johnson, P&G, McDonald's, and Walmart are well known for providing necessities for US people. On the other hand, 5 other stocks are tech or innovation companies. Salesforce, CRM, is a cloud-based company for customer relationship management and general business applications, while ServiceNow, NOW, is a cloud computing company to facilitate enterprise operations. And then Square, SQ, is a financial service and digital payment company on card reader. And then for foreign companies, from the US perspective, Alibaba is the Chinese tech conglomerate on e-commerce and online retail business. And then Taiwan Semiconductor Manufacturing, TSM, produce semiconductors. It should be noted that Buffett is famous for investing Coca-Cola and Cathie Wood has substantial investment in Square. Actually, Buffett once invested Walmart, while Cathie Wood once had positions in Alibaba and TSM. So here I would like to show the stock price movements. All stock prices are rebased with June 2016 equals 100. For traditional or mature companies, the stock prices generally pick up. If we notice the impact of COVID-19 pandemic, it seems the impact on monthly prices can be easily seen for Coca-Cola, KO, and McDonald's, MCD, but seems not obvious for P&G, Johnson & Johnson, and Walmart. Perhaps this reflects their nature of selling daily necessities and medicines. For tech and innovation companies, Salesforce, CRM, and Alibaba rose at a relatively slow pace. although they are still faster than traditional or mature companies. These two firms may be relatively mature among the tech firms. TSM originally increased at more or less the same pace as CRM and Alibaba, but picked up faster since 2020 due to increased prices and demand for chips. ServiceNow, NOW, generally picked up strongly, perhaps reflecting rising demand for cloud computing. And then in particular, Square SQ in the lower part of the chart surged rapidly as its innovative credit card reader have been widely used in US. SQ also holds some bitcoins on its balance sheet. Here, if we take a look at the exact figures of expected returns and volatilities, traditional companies have annual expected return ranging from about 7 to 16%, which is lower than those of the tech and innovation companies, which are as high as 21 to even 66%. But volatilities of tech companies are much higher at 26% to 53%, while traditional companies' volatilities are smaller at 15 to 18%. As a result, Sharpe ratio of some traditional companies, such as McDonald's and Walmart, appears not too low. But some tech companies, such as Salesforce, CRM, and Alibaba, they have even lower Sharpe ratio than them. Here, I start calculating expected return and volatilities of equal-weighted 5 stock portfolios. This calculation is based on statistic formula in this slide. As expected, portfolio based on traditional companies has lower expected return, volatility, and Sharpe ratio. The Sharpe ratio is at 0.85, and the portfolio based on tech and innovation companies has higher expected return, volatility, and Sharpe ratio. The Sharpe ratio is at 1.43. One thing I would like to highlight is the Sharpe ratio. The Sharpe ratios of the two 5-stock portfolios are actually lower than the maximum individual stocks Sharpe ratio. In fact, the 5-stock portfolio may include those stocks with low return and high risk, such as Coca-Cola and Johnson & Johnson in traditional company portfolio, and CRM, that means Salesforce, and Alibaba in tech company portfolio. Most importantly, these stocks have moderately high positive correlation with other stocks within their portfolios. Because of these stocks cannot provide gain through diversification. Next, I calculate expected return and volatility of an equal-weighted 10-stock portfolio. From the table, you can see that the return and volatility of 10-stock portfolio is just in between those of the 5-stock portfolio. But Sharpe ratio of the 10-stock portfolio is higher than both 5-stock portfolio. It shows signs of diversification gain if one invests both traditional and tech stocks. From the correlation matrix here, we can see low return correlation between traditional and tech stocks, which can help enhance the risk-adjusted return. In fact, Sharpe ratios in the portfolio can have room for improvement if we can correct stock picking. That is, finding an optimal risky portfolio on the capital allocation line and as a tangent on the efficient frontier. I calculate the optimal risky portfolio using Python, which include return volatility chart as shown here. For traditional stock portfolio, the optimal risky portfolio has higher expected return and volatility, with Sharpe ratio picking up from equal-weighted 0.85 to 1.03. For the optimal rate, McDonald's, MCD, has the highest rate, and then Walmart, WMT, and then P&G. As expected, Coca-Cola and Johnson & Johnson is not added in the optimal risky portfolio. Similarly, I derived the optimal risky portfolio for tech portfolio. Compared to the equal-weighted portfolio, expected return is higher, while volatility decreases, As a result, Sharpe ratio for the optimal risky portfolio picks up from the equal weighted 1.43 to 1.71. Also as expected, Salesforce, CRM, and Alibaba, Baba, is not added in the optimal risky portfolio. Okay. For 10 stock optimal risky portfolio, the optimal risky portfolio has expected return and volatility in between the two 5 stock optimal risky portfolio. Again, the important point is Sharpe ratio, which is higher than both 5 stock portfolio at 1.84. The more important thing is the observation from rate. The 10 stock portfolio consists of P&G, McDonald's, Walmart from traditional stocks, and ServiceNow, Square, and TSM from tech stocks. The rate for traditional stocks is actually not as small as we expected, as 43% belongs to traditional stocks while 57% are from tech stocks. So these results suggest that both the traditional and the tech are important to contribute to the high risk-adjusted returns. And this, to some extent, shows the power of diversification in equity investment. To conclude, I would like to make suggestions for both Buffett supporter and Cathie Wood supporter. For Warren Buffett's supporter, if they add tech companies into traditional stock portfolio, they can greatly enhance risk-adjusted return. The old people can actually reduce positions on stock portion and hold more risk-free assets according to the separation theorem. So the old people can obtain the same return, but through lower risk. And then for Cathie Wood supporters, if they add traditional companies into tech stock portfolio, they can further enhance risk-adjusted return. The young people can then increase positions on stock portion with leverage, so they can obtain higher return given the same risk they can tolerate. For other observations, my results show that stock picking is important to enhance risk-adjusted return. But stock picking is difficult, and even investment guru can be wrong. In fact, Coca-Cola and Square may have been overrated in Buffett and Cathie Wood's portfolios respectively. It seems diversification should be easier to enhance risk-adjusted return. This can be done easily through diversification across different sectors, as well as international diversification, such as investing in TSM, in tech portfolio. So this is the end of my presentation. Thank you.
其實咧入邊嗰個精髓咧，就係3個臭皮匠勝過1個諸葛亮，體現咗呢一個分散投資嗰個精神，亦即係組合管理入邊其中一個好重要嘅精髓。咁我遲啲有機會就再可以探討多啲有關組合管理方面嘅我嘅一啲睇法啦。最後留意呢段 disclaimer， 呢段影片嘅目的係促進呢個知識分享、研究同埋持續學習，並唔構成買入賣出嘅投資建議或者係推薦。喺投資理財嘅道路上，記住保持獨立思考、謹慎行事，時刻保持良好嘅風險管理。多謝大家支持，除咗 like、share、subscribe， 最重要係歡迎大家嘅 comments。多謝晒。